Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. National Australia Bank last week delivered a 13% drop in first half cash profit to $3.55 billion. Quite a drop, but it did come after a stellar result the previous year. NAB went on to announce a $1.5 billion share buyback, kept its dividend steady. This week we have half-year earnings from Westpac and ANZ. We'll have a third quarter trading update from Commonwealth Bank as well. Plenty for investors to sink their teeth in when it comes to the big four banks. Remember, of course, this is general information only, and you should always seek professional advice before making investment decisions. Cacho is the Chief Economist and Bank Analyst at Jarden Australia. Now, Carlos, given we've got Reserve Bank this week as well, you're going to have a busy week.
I definitely will, Sean, and then we've got the budget the week after, so it's a busy couple of weeks with my two hats on.
Carlos needs more money. Just putting it out there. Tell me, what did you make of National Australia Bank's results last week?
Look, the headline result was broadly in line with expectations. As you said, it was down quite a bit from last year, but we knew that was happening. Margins have been under pressure. We were coming off record earnings, so it was never going to hold up at that level. The key thing for us, though, was the details were a bit better than expected, and there were three key things that really jumped out at us. First of all, we did get confirmation that margin pressure, while it does continue, is easing. We're seeing competition in both mortgages and deposits moderate, and the guidance from NAB was that was going to continue ahead. So that was a positive versus market expectations. Secondly, we confirmed again that the credit outlook remains pretty benign. Bad debts coming in less than expected, defaults, arrears, etc., kind of all the regular indicators us bank analysts look at, holding up better than people feared they would, and NAB noting that things had played out much better. And importantly, what that means is NAB is holding quite an elevated level of provisions. So the money they're putting away for the rainy day when things go pear-shaped in the economy are around the highest they've been since COVID, and if you exclude that, the highest they've been since the GFC. That's, given the current environment, looking like they're probably holding a bit too much there. And so there's the potential ahead, potentially in the second half or maybe in FY25, they could return some of those provisions, and that can support earnings in FY25. And then thirdly, what we heard is that credit growth is holding up better than expected as well. So in particular, NAB highlighted that business credit growth has been much more resilient than they anticipated, and their pipeline of new business lending is the strongest it's ever been in the history of the bank. So that comment on the earnings call really gave the market a boost of confidence in the stock, and it was traded up strongly following that.
I think Andrew Irvine, the CEO, said, I think astonishing was the word he used in terms of that. Is there a chance that because they're doing so well on the business lending side, and National Australia Bank being the biggest business lender vis-a-vis the other three banks, that NAB's actually outperforming on net interest margins because they're just not being as crunched as much in the heart of their business as, let's say, Commonwealth or Westpac might be because they're mortgage banks?
Yeah, look, absolutely. We do know that the margin for NAB's business bank is around 3%. The margin for their personal bank is lower, a bit below 2%. So it is certainly a more accretive and higher margin business. That is a positive for them. And they have purposefully, directed their business to be growing a bit below system in mortgages, a level that they're happy with, and doing really well in the business bank, particularly the SME space. So that's definitely a positive for them versus peers.
Okay, you mentioned mortgages there. The CEO kind of said he thought that we're at the bottom of that cycle or the worst was over. I can't quite remember the words he used. The competition in the mortgage space is tough, but some of the big banks, and NAB being an example, they're not being too aggressive in the competition part of it.
Yeah, look, if you compare where we are now to where we were 12 months ago, competition has definitely eased. Front book mortgage rates relative to the cash rate have increased by 10 to 15 basis points. If you look at banks' basic mortgage rates, they're up by more. They're up by about 45 to 50 basis points. At the same time, we've also had cashbacks have largely been pulled back. So last year in May, June and July, we saw most of the big banks end their cashbacks. You do still have one from ANZ and one from the St. George Group brands within Westpac. But by and large, cashbacks have kind of fallen by the wayside. So overall, we are seeing competition moderate. The other big change we're seeing is that we're seeing a lot less back book discounting. Back again, 12 months ago, if you asked your bank for a discount on your mortgage, they were pretty willing to give it to you, and you were getting often, pretty big discounts, anywhere up to 70 or 80 basis points at some stages. That's now mostly played through. And what we're now seeing is the rate for new customers coming in, the front book rate is now only just about 10 basis points above the back book rate, which is the rate for all existing loans. If we rewind about 18, 24 months, that was sitting more like 50 basis points. So that's come in a long way. And what that means is there's just less of an incremental drag from that repricing playing through. So margins are still low versus history, but they're no longer falling the way they were.
So if I go to my bank and ask for a cut when I come from a fixed rate home loan to a variable rate home loan, I've got less chance now than I did 12 months ago. Is that what you're sort of saying?
Yeah, you're not going to get a good a rate as you would have in February last year when the banks were competing really aggressively. They're generally still doing pretty well by existing customers. They want to hold on to those customers. They don't want to have to pay up, a commission to win back a loan through the broker channel to offset that. The other thing we are seeing, which should be a positive over this year, is that we're seeing the mortgage market shift from a refi-driven market to a purchase-driven market as the housing market continues to pick up and volumes lift. And that's really important because when you're refinancing, you don't have time pressure. You're not so focused on the service offering. Really, most borrowers are just going to be focused on the rate and how much money they're looking to save. When you're going to purchase a new home, that turnaround time, that service offering that the banks can offer, and in our view, the kind of premium service that NAB has, the kind of higher quality systems, are going to mean that they should be able to command a modest premium versus peers in the purchase market for that reliability.
Stay with me, Carlos. We'll be back in a minute. I'm speaking to Carlos Cacho, bank analyst at Jarden Australia. Okay, just before we move on to the other banks, what Andrew Irvine did say last week, and this you can put your Chief Economist hat on this one, he actually said there are pockets of the economy that are doing pretty well, and he said there was an overemphasis on the bad stuff. What do you take from his economic point of view?
Oh, we 100% agree with that. My view has probably been a bit more optimistic on the economy versus a lot of my economist peers. The consumer is soft, yes, but it's really a bifurcated outlook. We know that mortgage holders are doing it tough, but only 1/3 of households have a mortgage. Older Australians, those without mortgages who own their homes, are actually doing pretty well. We actually saw that last week in the cost of living indices as well, where cost of living for employees is up by over 6%, but cost of living for retirees is up by only 3%. So it just highlights this real difference in the experience of the economy at the moment for different households. And if we look outside the consumer sector, business investment is actually looking really solid. Residential construction is weak. We know that. It's going to slow this year. But non-residential building is actually quite strong. We've got a huge amount of infrastructure going in at the public sector level. And the government is still driving really strong spending kind of on the public consumption side. So overall, once you step away from the consumer and look at the other sections of the economy, it's actually holding up relatively well. And that's why we've been a bit more positive, particularly on credit growth, where we're expecting non-mining business investment to rise at about 10% through to end of FY25. And that should see more robust business credit growth than both the market and the banks themselves are expecting.
Okay, let's move on to Westpac and ANZ. What do you think will happen with those two? They've got their half-yearly results this week, and Commonwealth Bank's got its quarterly results. What are you expecting?
Look, I think we're going to see some similar themes come through in terms of continued signs of that margin drag moderating, competition easing, maybe a little bit less at Westpac and ANZ than NAB. NAB's played, been playing quite safe on terms of the margin volume trade-off when it comes to mortgages. ANZ and Westpac have been competing a little bit more aggressively, lower rates, cashbacks still in there. So they might see, they might not see quite as much of an improvement. Deposits, though, we are seeing across the board, deposit competition has definitely moderated since November, or has stabilised, I should say, sorry. And so that should still be a positive there. ANZ, the institutional bank, should continue to do well. We learnt from NAB last week that the institutional bank performed really strongly. They had an ROE of 16%, which is a great result. If that flows, if that's a signal for the broader sector, that should be a positive for ANZ. And for Westpac, we know that their quarterly update was quite strong on margins, so we would expect that to come through. And then, of course, what we're going to probably see again is bad debts coming in below expectations. The market doesn't think of that as a high-quality beat, but it is still a beat and it is still a positive. And I think we'll probably again hear from them that capital returns or kind of write-backs of those provisions are possible. The other thing that we're expecting is we probably get a large buyback out of ANZ. Now that the Suncorp deal is approved, they've got a bit more certainty on the outlook, or at least approved by the ACCC. And we expect they're going to announce their first buyback in 2 years. And with Westpac, we're expecting they may announce a special dividend. Westpac has a large balance of excess franking credits. And now that they can no longer do off-market buybacks, special dividends are really the only way to return those to shareholders.
Okay. What about share prices then? We saw a bit of a jump after the National Australia Bank result last week. They are trading at multi-year highs in the case of Commonwealth Bank, not far off total highs. Can they keep running?
Look, I think our expectation is that the banks hold up relatively well. It's hard to see material outperformance from here, but equally, we don't see a catalyst that's going to see them kind of derate materially either. We've got a neutral view on the sector, which is relatively favourable versus, I think, kind of what a lot of the market's thinking with the banks. And that's really underpinned by that favourable macro view where we're seeing this easing in competition, bad debts coming in less than expected, the potential for them to provisions to be written back, and credit growth holding up better than feared as well. So I think the way we're thinking about the banks is they're probably going to perform broadly in line with the market, maybe a little bit better, but it's they're certainly, the valuations certainly don't give you a lot of upside from these levels.
Carlos, thank you for talking to Fear and Greed, and good luck over the next week with budgets and reserve banks and bank reporting. Do you get any sleep or not?
Well, it depends on what the 18-month-old decides to give me.
Oh, wow. You've got a busy couple of weeks. That was Carlos Cacho, bank analyst and chief economist at Jarden Australia. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.